From New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, markets betting on a downshift as the Fed makes the case for higher rates. And this is all as issuers unleash a record wave of bond sales. We begin with the big issue, recession or recovery?
We have a Fed here who's not backing down.
They're very concerned of being the Fed that paused too early.
Some speakers, members being fairly hawkish, some less so.
Inflation is on its way down. The economy is slowing.
We hope that the Fed will engineer a soft landing.
On one hand, if we're going to recession, bond yields at the longer end of the curve are still too high.
Perhaps there's a little bit too much complacency on what central banks are going to do.
If we're not going to recession, then it's kind of the opposite.
We think that you're going to get a recession.
But the jury is still out.
We have, amongst investors, a very, very different view.
We're in the don't stop camp.
We're more in the stop camp.
Maybe another 50, 75 basis points certainly does the trick.
We think 25 more basis points.
It really does depend where you look.
Joining us now, Goldman's Lotfi, Karoui, Kathy Jones of Charles Schwab, and Erik Nelson of Wells Fargo. And Kathy, I want to start with you because the data was a little bit messier this week, but between what we learned about the labor market in December, what we learned about CPI, it feels like there's a little bit more optimism about the economy. Is that premature?
I think what we're in is a sort of up and down rolling recession type of economy. So we have areas of real weakness like housing, and we've got some disinflationary pressures stemming from the supply side coming back and some cooling off of consumer spending. On the other hand, you have a pretty firm labor market still, and a fair amount of rebound in terms of optimism in the global economy. So it's really kind of a mixed picture here. Our view is we're still in a weak economy or a weakening economy, and the risk is that the Fed tightens into that we will in the second half or as we go through the year get a much weaker economy.
And so let's talk about what that means for the Fed, Erik, because it feels like, again, we have the market trying to fight the Fed here, but there is growing optimism, one that's been supported by Fed members themselves, that there's going to be a further downshift in February to 25 basis points. We just heard from the Fed's Chris Waller favoring raising rates 25 basis points at the next meeting. What do you think? Is it too early to downshift once again, or do you think that is appropriate given what we've learned?
Well, Katie, I think the Fed is comfortable going down to 25 at this point. What strikes me is that the question is less about the path as it was in 2022 and more about not only the destination, but how long we stay at the destination. Our big view is that the market is a little bit premature in pricing in those cuts in the second half of this year. Certainly acknowledge that 6 to 9 months from now, if the data really are rolling over on a more consistent basis, the Fed probably will cut. But we think there's still a little bit more runway left in this U.S. economy, and so we're not quite ready to lean into the cut pricing at this point in the cycle.
And I want to talk about what that means for the bond market, because, Erik, I remember in December you made a very bold call that really 10-year Treasury yield should be closer to 425 to 475. And if I check where we are right now, we're a bit closer to 350. Are you sticking by that call?
It's always fun to watch the price action move against a bold call. So it's been certainly a tough chart to watch in the first 2 weeks of the year. We have to be careful here. It's easy to get lulled in by the price action as a sign of what's to come. But I think our fundamental view in terms of the direction hasn't changed so much. What surprised us are two things. One would be inflation and wage growth have been much more well-behaved than we'd expect. We would also say that the U.S. data have been a little bit shakier than we'd thought. So, again, we're still the view that the Fed won't be cutting for quite a while here, but that really bearish view looks a little bit more out of line at this point, and not just because of the price action. So we're still expecting a 4 handle by mid-year and the 10-year Treasury, but that sort of high 4 scenario is looking less and less likely given the fundamental backdrop.
And of course, all of that really depends on not what just the Fed does, but what the Fed's actions mean for the economy. And even though it seems like the mood music is a little bit brighter, there's a lot of question marks, Lotfi. And I'm curious, in your view, are you on the camp of recovery or are you on the camp of there's a recession coming?
We're in the recovery camp, although you obviously have to acknowledge that the price action and the velocity of the price action has been quite impressive in the past couple of weeks. But look, I mean, we're still stuck in a range, but relative to 2022, that range is certainly narrower. And then more importantly, we are a lot closer to the end of the tightening cycle than the beginning. And so what that will do, it will likely continue to fuel this decline in vol in the rates market. And that's a very supportive, technical factor for risk appetite in credit. But to me, there's been a number of shifts that are important to recognize here. The growth inflation trade-off has improved. Yes, there's been some weakness in the soft data in the U.S., but overall, the hard data is looking good. And we're also of the view that the peak drag in from tighter financial conditions on the real economy is likely behind us at this point. I think what that also tells you is that over time, it should create greater tolerance from central banks vis-a-vis somewhat easier financial conditions, maybe not too much easing obviously becomes counterproductive. But I think we'll see some kind of a recalibration in the Fed and ultimately the ECB's reaction function away from upside surprises in inflation and back a little bit into downside surprises in growth. And that's a friendly shift for risk appetite.
Well, let's talk a little bit more about the Fed's reaction function, because we heard from Fed Vice Chair Lael Brainard earlier this week making the case for higher rates, saying, quote, even with the recent moderation, inflation remains high and policy will need to be sufficiently restrictive for some time to make sure inflation returns to 2% on a sustained basis. And Kathy, it seems like the for some time is the key part of that quote. In your view, what is for some time? How long do you think that the Fed will hike and then hold?
Well, that's the big question in the market. So what they're telling us is that they want to get to 5.25, and they want to hold it there throughout 2023. I think if that were to be the case, and we probably should take them at their word, at least at this stage of the game, that that's what they believe they should be doing, then that's going to send bond yields even lower and raise the risk of recession and probably reduce the risk appetite in the market. And that might be what the Fed is intending to do. That's certainly what they have done to date. So we're in the camp that says if the Fed follows through and actually does this, they're really over-tightening. Keep in mind, as inflation falls, even if they stay steady in terms of rates, they're actually tightening policy. We still have quantitative tightening taking place behind the scenes. So that's a pretty tight policy. We still have tight policy in most of the major developed countries of the world, and starting to roll over a little bit, but not there yet. So I think the big mistake here, if a part of the market might be underestimating what the Fed decides to do and betting on them relenting and coming back to the market's point of view in terms of easing policy sooner rather than later. This feels a lot more like the kind of Fed reaction function we had pre-financial crisis rather than post-financial crisis.
Well, Kathy brings up the topic of over-tightening, and that's definitely a fear that maybe was more present in the price action this week when we got that bigger than expected contraction in retail sales and in PPI. And Erik Nelson, in your view, the concept of over-tightening. First of all, when will we know that perhaps the Fed has gone a little bit too far? What would that look like? And how big of a risk is it in your eyes?
Well, Katie, the fact that, and Lotfi pointed this out, is inflation's coming down, the risk of over-tightening is lessening at the margin. But I think the reality is the Fed is still looking at a lot of coincident and maybe even lagging indicators and trying to guide where policy is going. It's sort of typical Fed sort of cycle, late in the cycle, they're sort of driving through the rearview mirror, if you will, which is a very challenging environment for the real economy. There's a lot of focus on lags inherent in policy. Housing is, of course, the first major sector to react, but corporate and household balance sheets take much longer to absorb these hikes. So it's very hard to see this in real time or even, 1 or 3 months hence. So I do think that the risk of over-tightening at this point, in particular to Kathy's point about staying high for too long, is still quite elevated. And so we're very cautious on global growth here and certainly expecting another challenging year for risk.
Well, Lotfi, come in here on the housing market because I know it's one that you've been following. And if you are in the recovery camp, what does that mean for the U.S. housing market from here, given the turbulence that we've seen?
Well, housing is one of the most, if not the most rate-sensitive sector of the economy. And I think what you've seen over the last couple of months is a normal response to deteriorating affordability and higher mortgage rates. There's, broadly speaking, two camps. The correction camp, a peak-to-trough decline of, call it 10 to 15%, and then the crash camp, which is a 25 to 30% correction. We're actually in the former camp. I think we're on the right track for some kind of a correction. I think to think that we'll have a 25 to 35% decline peak to trough, you'd basically have to attribute, the entirety of the appreciation that we had post-COVID to easy financial condition. And we just think that there were other factors at play. The fact that supply in the housing market was very tight. Demographics obviously played a big role into that. And so, yes, we are correcting, but I don't think that that correction is going to morph into something similar to what we experienced in, call it 2007, 2008, for example.
Guys, we're just getting started. That is Lotfi, Karoui, Kathy Jones, and Erik Nelson, everyone sticking with us. Up next, it's the auction block. Global bond sales off to a record start. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where issuance is off to a record start. Global governments and companies have sold around $600 billion. That's the biggest tally on record to start a year. Over here in the U.S., the big banks headlined high-grade issuance. Morgan Stanley and Bank of America is selling $9 billion in fresh debt. And in emerging markets, over $40 billion in bond sales marked the best start to a year in more than a decade. Investment-grade debt accounted for 92% of total issuance. Sticking with EM, Gramercy funds expecting significant upside ahead. Take a listen.
There's a tension between FOMO, fear of missing out, and also climbing the wall of worry. And, I think we got to go back and look historically at the dislocations that we've seen in emerging markets and see some of the returns that have come out of those. And, over the last 25 years, we've had like 11 of them. The peak to trough is down like 20%. The recovery takes about 8 months, and it's typically been like 27%. And then 12 to 24 months over that, after that, you see very strong returns, like 30 to 50%.
Still with us, Lotfi, Karoui, Kathy Jones, and Erik Nelson. And Erik, sticking with EM here, it looks like there's plenty of demand to meet that supply, at least judging by some of the ETF inflows. But put this into context for us. How does EM debt stack up against some of the more U.S.-centric debt, for example?
Well, you've had central banks across emerging markets hike a ton, and a lot of, especially in Latin America, you're looking at 10 to 15% nominal yields. So despite the upside we've seen in the developed market yields, that gap is still really substantial. And as the Fed is moving toward cuts, these EM central banks are also moving in that direction. And that's, of course, great news for fixed income investors. The big question here about the longevity, though, of this EM rally, Katie, is really how long can global growth hang in there? China reopening is certainly a big wild card, but you have a sort of a negative cycle taking hold in some of these Western economies. We have to be very careful here about chasing this rally in EM. We think it can last for a few months, but come the second half of the year, it could be a very different story.
So be careful about chasing the rally. Let's talk about chasing the rally in U.S. markets when we think about the relative value between investment grade and high yield. And Kathy, this is where I want you to weigh in, because if I look over your notes, I see that you're not yet ready to really buy into what we're seeing in the high yield markets. What would look like a more attractive entry point?
Well, we need to see spreads widen out quite a bit. We really haven't had widening spreads beyond average during this cycle yet. And typically, as you go into a downturn, a Fed tightening cycle, and particularly a global tightening cycle like this, after very loose underwriting standards over the last couple of years, you would expect to see some of that deterioration in credit quality reflected in wider spreads. We just haven't seen that. Now, clearly the yields are very attractive, and that is drawing in money, and your prospects for returns are pretty good, but we would not be pushing it. You know, corporate profits are still declining, and the economic growth is still probably likely to soften going forward. We still have tightening by the central bank. That's not really a great backdrop for high yield bonds when you can get a pretty attractive return in investment grade bonds with a lot less risk.
Well, earlier this week, on the topic of high yield, we had Howard Marks sit down with Bloomberg's Romaine Bostick and talk about its recent performance. Take a listen.
The current prices are roughly sustainable. When you say, is the rally sustainable, they're not going to keep going up. That is to say, yields are not going to keep coming down, in my opinion. The debate today is being dominated by people who are optimistic, by people who think that the recession won't be too bad, won't be too long, that the inflation will give way, and that the Fed will be able to turn accommodative soonish.
Are you optimistic?
Not on that subject.
Lotfi, I want to get your thoughts on that because it feels like there's some sort of consensus forming. I've spoken to a lot of investors who favor investment grade, higher quality credits over maybe the riskier parts of the market. But where do you fall in that debate?
I think it's still an up in quality world. And so you can frame it as overweight IG versus high yield, or within the high yield market, overweight single Bs over triple Cs, et cetera. But the reason I continue to think that is that fundamentally, even though the cyclical outlook has brightened, if you sort of bring things down at a micro level, basically companies are facing a combination of much higher levels of funding costs at a time where the ability to grow earnings and offset some of that increase in funding costs is fairly limited because, again, the first order condition to bring inflation under control is to keep growth below trend. And that combination really hurts the most. The lower you go in the quality spectrum, the closer you get to rate-sensitive balance sheets, the more difficult that transition is going to be. And so I have to the extent there's consensus around that view, I find myself in that consensus. I do think that this is still an up in quality world.
Well, Lotfi, I'm really happy that you're with us today because you recently revised your 2023 spread forecasts tighter. What is your current expectation for how things play out this year when it pertains to spreads, and why the change?
I mean, we're basically envisioning a return to the range that prevailed in the first quarter of 2021, so not quite a complete reversal of the widening that we've had. Why the change? I think we went through a material reduction in left tail risk. The risk of a new monetary shock, which was the biggest story of 2022, that risk has come down, quite substantially. But you've got signs of improvement in the growth inflation trade-off with wage inflation cooling down, price inflation is cooling down. You look outside of the U.S., the recession scenario seemed inevitable in Europe only 3 or 4 months ago. Now you can make the case that the odds of a recession in Europe are actually declining. The winter has been a lot warmer. The reopening in China is good news. And so credit, perhaps more so than the equity market, is a lot more sensitive to the left tail of the distribution. And to me, there's been unambiguously a sharp decline in that left tail. And so we're in still for a range. But I think that range is a lot narrower this year relative to where it was in 2022.
Lotfi, Karoui, Kathy Jones, and Erik Nelson, everyone is sticking with us because still ahead, it's the final spread. The week ahead, the U.S. getting its last dose of data before February's Fed rate decision. We'll discuss next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up, Euro area getting a read on the consumer on Monday. Then we have global PMIs headlining Tuesday, a Canada rate decision on Wednesday, and then the U.S. closing out the week with a large dose of data. GDP, PCE, and UMich sentiment survey are all on deck. We are back with our roundtable now, though, and before we get to the rapid fire round, really quickly, guys, I'm curious to hear what you're watching in the week ahead, because we have absolutely no Fed speak. Kathy, I want to start with you. What is your big focus next week?
It's going to be the PCE numbers, the core PCE. I think that's one of the key data points for the Fed, and I think for the markets. They're going to need to see continued improvement in those numbers to continue to be optimistic about the potential for the Fed to slow down.
Erik, what about you? Are you also keeping an eye on PCE, or what is tickling your fancy?
Well, absolutely, that's going to be key. I'm also watching those PMIs, Katie. Europe, UK, we've seen this narrative of resilience in Europe and the UK and starting to see some data rollover in the US. Not necessarily buying that narrative at this point. We'll see what the PMIs have to say.
Lotfi, 10 words or less. What's your big focus?
Yeah, I have to agree. I think PCE is going to be key. We need to get confirmation that we're on the right track as far as the trajectory of inflation goes. PMI and other soft data, I also very much agree with that.
All right, guys, it's time now for the rapid fire round. 3 questions, 3 quick answers. Kathy, kick us off. 25 basis points or 50 basis points from the Fed next month?
25.
Erik?
25.
Lotfi?
25.
Kathy, does the Fed cut rates in 2023?
No.
Erik?
Yes.
Lotfi?
No.
Okay, a bit of a discussion there. And Kathy, do credit spreads end 2023 wider or tighter from here?
Wider.
Erik?
Wider.
Lotfi?
Tighter.
All right, guys, great discussion. My thanks to Lotfi, Karoui, Kathy Jones, and Erik Nelson. And we have a big week ahead. Even though we don't have any Fed speak, we have a ton of data coming at us from GDP to PCE, and we have earnings in there as well, but that's more of an equity market story. Right now, you're looking at a bond market with a 10-year Treasury yield at 3.47%. You look at what this week has brought us, it's brought us a rally. That yield has moved 8 basis points lower on the week. We're going to continue to watch that story and how it evolves all next week. But from New York, that does it for us for now. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.